I would want to extend a very warm welcome to everyone in this room, and thanks for coming on this weekend. And even after the presentation, I'll be outside. We can exchange ideas. Uh, I think one thing which has become very important in the market is that the last 4 5 years, practically everyone has made a huge amount of money. Somebody has made more, has made less. What has become important is that the easy part of making money is behind us now. Now it has become more difficult to look for ideas. And this is something, when I go for meetings, earlier I remember 8 months back, investors used to give me ideas. As of now, when I go for meetings, they ask for ideas. So that shows that the easy part of making money is behind us. Just to give you another example, 8 9 months back, almost 60% of the small caps used to outperform the small cap index. As of now, that number is around 25 to 28%, which means the breadth of the market has gone down. So this actually brings us to a point that it's a good time to look back and see what are the basic fundamentals around which one should be investing in the market, because Indian markets are very different. Indian markets are not same what the US markets or the European or the Southeast Asian markets are, and slightly different. And that's where I would say it becomes important to go back and see where the basic fundamentals are. Over the next half an hour, I'll try to capture these three basic points: value versus growth. We keep on hearing the debate, which is the right part of the market to be invested in. To be honest, there is no right, no wrong. There are different times when value gets rewarded. There are different times when growth gets rewarded. Second thing, which is very close to my heart, is sector rotation as a style. I remember when I began doing sector rotation almost 8 10 years back, it used to be very alien concept. People used to be saying that, there's no point in doing, getting in and getting out of the sectors, just buy and hold good companies. But I think of late, more and more people are talking about being there in the right sector and also getting out of the wrong sectors. And lastly, I'll talk about the opportunities which are there in the market and whether it makes sense to be bullish in the market, because any interaction with any investor which you would have, first thing which happens at this point is that, don't you think the markets are expensive? Don't you think the market should come off? So we'll talk about that in the last part. So to begin with, value versus growth. I'm sure most of you know what's value, what's growth, but just to kind of, make it more easy to understand, value is the most boring part of the market. It all consists of all the old economy boring sectors. Typically, you'll have your engineering, capital goods, energy, power, PSUs. So who touches the PSUs? Infrastructure, cement, consumer staples, autos. So these are all the boring sectors. They were boring, but I'm sure last 4 years, they have not been boring. So now typically value sectors are identified by the low P, low price to book, high dividend yield because they generate a lot of cash, and their top line, bottom line growth is very slow. So that's the reason they look very, very uninteresting and boring. The growth part is more exciting. That is where, people have been always talking about the growth part of the economy. Now within the growth sectors, they are identified by, your high P, high price to book, very low dividend yield. Many of them might not be even making profits. For example, the new age companies. So there is no question of dividend yield, and their top line, bottom line growth is very high. So typically sectors like, your consumer discretionary names, the new age companies like your Zomatos, the Nikas of the world, IT companies, the retail focused NBFCs, private banks, pharma, healthcare, these all fall into the growth category. And these are the areas which has historically got a lot of the attention. Now, it's not that, one part always is there. We have seen the value migration also, wherein, value sectors migrating to the growth part of the market. And this is something I have witnessed over time in different sectors. Just to give an example, there was a time when the chemical industry used to be considered the value industry. Growth was very low. Multiples were extremely low. Top line, bottom line growth was less. Multiples were low. And they were kind of not very exciting businesses. We saw what happened post-pandemic. We saw multiple expansion in their top line. Top line growth was huge. Bottom line growth was huge. ROEs improved. Margins improved. Multiples went up. So we have seen that happening for the IT sector also. Over time, different sectors have moved from value to growth also. That is where your multiple expansion happens. The other part is wherein the reverse happens, wherein multiples contract because of, the things happening in the reverse direction. We have seen that in the last couple of years. I'm sure most of you have experienced what has happened in many of the private banks. They have seen a huge multiple contraction. Historically, private banks are considered to be the growth part, but yes, because of different aspects with regard to their earnings not doing as well it was happening in the past, and different parts of it, they have seen the multiple contraction. So you see this value to growth and growth to value also happening, and that is the reason it is very important to be more agile with regard to constructing your portfolio, keeping both parts of the market. Now, if I see the world markets in the last 16 years, why I'm saying 16 years, this is post the 2008, the big fall in the global market. In the last 16 years, practically 80% of the time, internationally, the growth part of the market has done well. And that is where, if you see all the new age companies, your tech companies, Amazons, Facebooks, Alphabet, all these, Tesla, Apple, all these companies, they have been dominating the global, equity markets over there. Now, that is because there was a lot of the liquidity which was pumped in the global economy, and that is where growth has dominated practically 80% of the times in the last 16 years. India is a very unique market. Here, both value and growth have done well. If you look at all these companies and sectors, so I've basically put up just one company within each of these sectors, you will see both value and growth have done well over all the time frames. Whether it's 1 year, 36 months, last 5 years, all of them have done well. So if you had just been biased towards one part of the market, imagine you would say that I just want to look at deep value. I don't want to touch the high growth companies. You would miss out on a Tata trend. You would miss out on a Zomato. On the other hand, if you said, I only want to bet on growth, I don't want to bet on the deep value, you would have missed out all the defense stocks. You would have missed out the PSUs. So it's very important to see that India is a very different market, and that is where balancing both value and growth has become more and more important. And that is something I've been adopting for the last 8-10 years. Looking at which part of the market gives you more opportunities, that is where you align. As of now, if you ask me, where is the biasness? I would say more and more growth allocation is there in the portfolio. Part of it is because many of the companies which were value have migrated to becoming the growth stocks. And that is where, if you see practically in my portfolio, 65 to 70% would be into the growth part of the portfolio. Coming to the second part, which is, as I said, very close to my heart, which is sector rotation. Very simple. There's no rocket science. Sector rotation simply means be there in the right sector at the right time. Easy to say, difficult to implement. But it's not that you need to get your sector selections right at all points of time. The basic idea of sector rotation is you need to capture the business cycle. I'm sure all of you know about so many business cycle funds which are there in the market. And it's an inherent way the economy works. Markets are nothing but a reflection of what is happening in the economy. If the economy follows business cycles, there is no way you can't do sector rotation in your portfolio. Business cycles, without getting the details of each of the parameters, you typically have these 4 business cycles. If you ask me where we are today, I would say we are in an early stage of an expansion. We would have exited part of the trough in some parts, and gradually we are in an early phase of an expansion. Now, sector rotation is something which has become more and more important because business cycles, they lead to earning cycles. Earning cycles, they lead to the valuation cycles, which means at the bottom of the business cycle, your top line growth, bottom line growth, margins, ROE, they are all very, very unattractive. That's the time nobody wants to be there, and that's the time the valuations are on your side. At the top of the business cycle, when everything looks good, your top line growth, your profitability growth, your margins, your ROE, everything looks good. That's the time your valuations are not on your side because everybody wants to be there. So business cycle and sector rotation, they go hand in hand. And that's the reason I would say it has become more and more important to do sector rotation because the cycles have decreased. Earlier things which used to play out, it used to take anywhere between 12 to 16 quarters. Now that we are seeing playing out between 4 to 8 quarters. Because business cycle leads to earning cycles leads to the valuation cycle. Now, what I mean by valuation cycle is defense was very attractive, say 8 quarters back, valuations was cheap. If you ask me, yes, defense has a long headway for growth even today, but valuations are not cheap, which means business cycle continues, but valuation cycle has become expensive. So you have to get out of those places. IT continues to do well, but there was a time when you had to exit out of IT. So valuation cycles have become much, much shorter, and that's the reason you need to get out of those companies. It also keeps a valuation of your overall portfolio in check, that you're not sitting with a very high PEG ratio of your portfolio in the of companies in your portfolio. Now, this table basically shows the returns of different sectors over the years. The numbers in green are the top 3 performing sectors in that year, and the numbers in pink are the bottom 3 performing sectors in that year. Now, typically when I talk about sector rotation and all that, the view I get is that, defensives always do well. If you look at the defensive sectors, whether it's pharma, consumer, IT, you have seen that they have also gone through the good time and bad time. Typically, the view is that it is the cyclicals which go through the good times and bad times. Even if you look at the cyclicals or the defensives, it shows that there is no sector which has been there in the top 8, 10 or the bottom 8, 10 consistently over the last 8, 10 years. So it's very important to move between the sectors, and you need to be there in the right sector. This is more elaborative. It's all about, as I mentioned, there is no the magical formula. How do you decide which sector to be in and which sector to be out? It's an ongoing process. We interact with hundreds of companies, and that is where we get a sense that is it a time to start getting bullish or bearish in a particular industry. Before I come to this, I'll just give you a glimpse of, last couple of years, how what portfolio changes I would have done in the portfolio with regard to the sector shifts. So 2020 and 2021, so these two were the pandemic years. Almost 65% of my portfolio was into the into the 4 sectors: pharma, chemicals, IT, and FMCG. So these 4 sectors made up almost 65% of my portfolio. This was during calendar year 2020 and 2021. Now, without getting into details of why those sectors, we all know that pharma was going through a massive earnings upcycle, multiple expansion, ROE expansion. US FDA was giving approvals almost every month. Indian pharma companies were exporting also. So that was a time to be bullish on the healthcare space. Chemicals, the whole import substitution became a big theme. Indian chemical companies were having the best times of the years. And that was, again, one sector I was bullish on. Again, IT, with everything migrating to the cloud, it was inevitable that Indian IT companies were most well positioned to take advantage of that. You had margin improvements because of employee cost going down. People didn't have to travel overseas. There was no visa cost, and that's the reason you had IT companies doing well. And FMCG, because all of us were at home, we were consuming up to our heart's content, and FMCG companies were also doing well. So these 4 sectors, pharma, chemicals, IT, and FMCG, made up almost 65% of my portfolio during those 2 years. From 2022, somewhere in the first quarter of calendar year 22, I started decreasing my allocations over there because valuations had become very rich. Something like a Tata Elxsi, which I had bought at 600, 700, even at 1100, I started exiting at 5,000, 6,000. Finally, completely, I was out of it at 8,500. When I entered, it was at 18, 19p. When I exited, it was at 75p. So from 22 calendar year, I started decreasing allocations into all these sectors, which is pharma, chemicals, IT, and FMCG. By end of December 22, that 65% went down to around 18 to 19%, which means almost 45 to 46% I exited out of these 4 sectors. Where did that allocation shift into? It went into urban consumption, it went into industrials and capex cycle, and it went into banks and the financials. During COVID, I was very underweight on the banks. Index had almost 30% into banks. I was sitting as low as 14%. Urban consumption, which during the COVID years was around 14% in my portfolio, became 42% in my portfolio. What is urban consumption? Urban consumption is basically about where do we spend money. One part into the real estate, one is autos and auto anks. The third is consumer discretionary, and the fourth is your the hotels. So these 4 made up almost 42% of my portfolio. Second part was your industrials and capex, which is all about manufacturing, which we'll see in the next slide. And the last part was your banks and the financials. So that those 4 sectors which were earlier, they went down to 18, 19%. And these 3 sectors, your urban consumption, industrials, and BFSI, became almost 85% of the portfolio. So this is the big shift which happens. People ask me that, if you're saying sector rotation, will the churn be very high? It's not very high. Roughly around 40% is the churn. These sector cycles take some time to play out. As I mentioned, anywhere between 4 to 8 quarters where these sector cycles, it happens. Now, coming to the last part, which I think more and more, it's becoming important, that does it make sense to bet on India? Valuations are rich. We keep on hearing so many people talking about valuations being rich in the country. Market should fall. In fact, many people keep asking that, that the market is not falling. The reason is that everyone is expecting the market to fall. Consensus, it never works. And that's the reason the markets are not falling. But to be honest, I would say we have multiple enablers behind us, which is supportive of where India is heading. And I just try to put them down into these six to seven kind of pointers. The first is about, I would say, the enabling the regulation. And I think that is where government has done an excellent job in the last 4-5 years of taking advantage of the opportunity. The last 4-5 years, the two good things which has happened for India, one is pandemic, second is the Ukraine war. Post-pandemic, world woke up to the fact you can't depend on China for everything. China plus one happened. Post-Ukraine war, energy prices went over the roof, manufacturing in Europe became impossibility, and Europe plus one also happened. So these two things, government took advantage. They announced PLI schemes, and they announced all these benefits for manufacturing in India. And they focused that we want to manufacture in India, whether it's defense or it's other electronic goods, capital goods, auto anks. That was an enabling regulation. That intention was there on the ground, and it was executed by putting the policies in place. Second aspect, which is, I would say, a big enabler of where we are headed and why we are different from the rest of the world, is financial inclusion, which means almost everyone now has a bank account. And last 8-10 years, that is something which has happened. We don't sense the benefit of that, but to be honest, if everyone in the country has a bank account, very easy to transfer all benefits to the end user. And that is something which has been happening. The third part is about support of manufacturing, which means if you just announce PLI, it doesn't help. You have to have your ports, airports, highways, the railways, dedicated freight corridor. All these things have to be there up and running. And that is where the public capex has been working for the last so many years. And now it's a time for the private capex to pick up. So all these enablers for manufacturing has been put in place. Financialization of the savings, I think that is something we can all be very happy about, that we have actually done an excellent job, but we have a long way to go. Pre-COVID, we had 4% of the household participating into the equity market. That has gone up to around 11% now. I would say we are doing good, but we have a long way to go. Simple fact, most of the developing countries have anywhere between 16 to 20% of their household into the equity market. Developed markets have 45 to 65%. We are at 11%, but we have a decent amount of headroom to grow. Now that is where comes the answer that, again, investors ask that when will the SIP stop? SIP won't stop, it will only increase. When will the domestic money stop coming to the market? There is no way the domestic money is going to stop coming to the market. More and more money will come to the market, because now your alternate avenues of investing, whether into the real estate market, everything has been brought post-tax at par with equity. So I would say that has become a very important factor, that more and more savings will come into the equity market. Cost of credit in India has been a big enabler, wherein our cost of borrowing, our banking system, our central bank have been very, very robust. And I think that is something which makes our financial system very strong. And that is kind of an enabler for all the manufacturing and industrial activity in the country. The sixth part is about demographics. I think that is where we have a very big advantage, because India is a very young population. Our median population is around 29. For China, that is 39. For Japan, that is 49. You can understand the age gap between Indians and the Japanese. So I think in the problem of having a large young population is that it has its plus and the minuses. The positives are that if a large young population gets into the job market, you will have more and more of the manufacturing, more and more of the consumption, the production, per capita income going up will also benefit. The negative side of having a large young population is if they are unskilled and unemployed, it's a dangerous thing. And that is where I think the government has understood. And now, if you see in the budget also, they made decent amount of announcements with regard to upskilling of the youth. Almost 1 crore youth will be given internships over the next 4-5 years. And I think intention is there in the right direction. But I think demographics is to our advantage for a large reason. And that is where I would say we have a benefit compared to the rest of the world. And the last part is about adoption of IT. I think we have done better than most developed countries also with regard to our adoption of IT in different walks of life. Now that gets translated to all these enablers which I mentioned is getting translated to the actual numbers on the ground. If you look at the ranking for India on the left hand side, we have been going up the rank in different parameters, whether it's the manufacturing of the mobile phones, electricity production and all these things. we have been consistently over the year doing better than most developed markets. The graph on the right hand side, it shows that over the last 20 years, India has always outperformed the world's GDP growth rate. Barring the COVID year, we have always done better than the rest of the world. Next 4, 5, 6 years, as per all estimates of IMF, the World Bank, and anybody, India is expected to continue to maintain that 4-5% edge over the global GDP. And that is where India's weightage in the global GDP is increasing. If the world is going to grow at 2.5% and you are going to grow at 6-7%, every year you will increase your share in the global GDP. And that is where India is headed. It gets reflected again in the manufacturing rank. If you see, we were nowhere among the top 10 in the manufacturing earlier. We entered at the rank 9, then 6. Where we stand today, we are at the rank 5. Very soon we'll replace German economy and go up to the rank 4. So this is something which is actually happening on the ground. It's not that, PLI announced ho gaya, but kuch nahi ho raha hai, and, all these policies have been announced. This is actually thing happening. We never in our life imagined that we will export defense equipments. We never in our life thought we will export iPhones. These are the two things I'm mentioning because these get the headline. Beyond that, across auto angs, chemicals, capital goods, different aspects, a lot of capex is happening in the country. I've met so many companies which are mid-sized companies and all. They have their aspirations which are very, very high now. They want to compete on an international scale, and that is where I would say India's manufacturing rank can only improve from here on. Public and private capex, it goes hand in hand. The last 4, 5, 6 years, a lot of public capex has happened. Almost 1 lakh crore of PLI benefits have been given. That has a multiplier effect. If you see, it's almost 8-9 times is the multiplier effect of that. From here on, it is the private capex which has to take on the responsibility of building jobs, because it is the SMEs and the MSMEs which create more jobs. Public capex does not create so much jobs. They are an enabler for getting the private capex into the market. Once the private capex happens, that is what it makes more jobs. So that is what I would say from here on the next 6-7 years, you will see the private capex picking up. And the number for private capex is way bigger than the public capex. If you look at the next 6 years, the amount of private capex which is planned, it is huge. And that is much, much bigger than the public capex which is happening. Now, when you create jobs, so basically manufacturing has to pick up with all these enablers from the government. So manufacturing picks up. It creates jobs. More and more the youth get jobs. The household income increases, which means your per capita income also, it starts going up. Now, we have already crossed that magical number of the $2,000 in 2019. Where we stand today, we are at roughly around $2,400 per annum. Now, what you see on the right-hand side is that different economies, once they cross that $2,000 per capita income has seen kind of a hockey stick kind of a movement, wherein you see a very sharp up move from where it is. In the next 6 years, our per capita income is expected to cross 4,200, which means from where we are today, it's going to see a massive, massive jump. Now, what it changes is what you consume changes drastically. When you are earning $2,000, almost 80% of your money goes in meeting the basic amenities. As your per capita income, this is it's a fact for all of us. If your disposable income goes up, you spend more on the luxuries, more on things which you want, not what you need. So basically, as your per capita income goes up, your consumer discretionary items of want goes up, and your percentage-wise consumer discretionary or consumer staples expenditure on the needs, it goes down. The graph on the right gives you a picture where the growth can come from. Just look at the numbers where India's penetration of the four-wheeler is. We are at the low single digit compared to China, which is at around 15-16%. Air conditioners, India is a hot country, but only 8% is the penetration. Where China is, we have a huge way to grow. And this is where, as the per capita income goes up, these are the, I would say, the things which enters the house. I'm sure you would have seen very small houses, but they have an AC outside their house, because once you get that much of disposable income, these are things we want to spend first on: a refrigerator, an AC, buying a bike. So these are all, I would say, things which give you confidence that you have arrived. So there's a lot of growth which can happen. And that is where I would say next 4-5 years, there's no reason to be negative on Indian economy. In the next 36 months, we'll add almost 40 million affluent Indians. which is almost equal to the number of affluent Indians who, as of now. Affluent Indians, the definition is anyone earning more than $10,000 per annum. Any household earning more than $10,000 per annum. Now, if you have 40 million affluent Indians getting added in the economy in the next 4 years, imagine the amount of consumption of all these items which I mentioned is going to go up exponentially. Now, the good part of this is that we as an economy have been producing and consuming. Now, this is going to become you can say the virtuous cycle. As you manufacture more, you get more job creation, more household income, more consumption. As more consumption, more of the production of those items, again, the companies have to do a capex. So it's kind of the virtuous cycle which can take care of itself. It doesn't go on for infinity, but it goes on for a long time. We saw what happened in different economies. So that is where I would say we are in a very sweet spot wherein we can continue to grow without depending on the rest of the world for a long time. And this growth is actually coming from both the premium and the mass category. So it's not that only the premium category is doing well, both premium and the mass category are doing well. And it is visible across different aspects, whether it's apparels, whether it's autos or different consumption goods. We are seeing that growth happening across. The last part is about the banks and the financials. So manufacturing and industrialization was the first part. Second part was consumption. Third part is your banks and financials. Banks and financials have a very important role to play if you're going to see a lot of manufacturing and consumption happening in the country, both because they support both parts. They support manufacturing as well as they support the consumption. If you look at our penetration of mutual funds, it's very low compared to our GDP. Insurance penetration, we know it's very, very low. So I think there's a lot of headroom for growth for all these aspects. And as I mentioned earlier, we have done an excellent job with regard to IT in different walks of life. All the more into the banks and financials, I think our implementation of IT has been much, much better. Over the next couple of years, you will see many fintech companies, the wealth tech companies getting listed. And that is also going to give you a lot of opportunities of participating in the wealth creation. So just to put it in the summary, what you should do, as I mentioned, we need to keep an eye on both value and growth. Don't get fixated in one part of the market. Be flexible. Second is sector rotation is very important. Don't try to hug the benchmark. If you don't like IT, don't buy any IT. In fact, for almost 8 months, 9 months, I didn't have a single IT stock in my portfolio. Benchmark at 14%, I didn't have a single IT stock. For almost 1 year, I didn't have a single the healthcare company. From not having any healthcare, now I have almost 8-9% into the healthcare. The last part is obviously, I mentioned about the different sectoral themes which I expect to do well. All this boils down to what has been the returns over the last 10 years since I've been managing money. The last 10 years, I can say happily, there has been only the 1 year wherein there was an underperformance compared to the benchmark, but that was the year of the Ukraine war. Barring that, there has been no year when the portfolio has underperformed the benchmark. And over the last 10 years, it has given an annualized outperformance over benchmark of around 7 to 7.5%. All these are after expenses. So consistency is something I believe is very important. So when you are investing yourself or you're showcasing any product to your investors, consistency of returns becomes the most important aspect. Good times, everyone does well. The real test happens in a bad time. Are you able to keep on doing well even in a bad market? That is the real test. And I think that comes from being agile in the market by taking those sectoral calls and the market cap calls at the right time. So that's broadly from my end. I can see the time is up. So we'll be there outside after the event in all the breaks. I'll be more than happy to engage with all of you. Yeah, thank you.